Hello everybody, this is Chris Robbins from Grand Street Wealth Management, and today we're going to talk about diversifying across style premiums. As always, you can go to grandstreetwm.com and click on blog to see all of our previous articles and videos. So when most people talk about diversifying a portfolio, they normally start by thinking about diversifying across asset classes. This would be like owning stocks, bonds, real estate, maybe commodities, together in a portfolio, and because these asset classes are somewhat uncorrelated with each other, the new portfolio will have a better risk-return relationship than a portfolio owning just a single asset class. Today we're going to dive into an asset class, namely US stocks, to see if we can increase our diversification by gaining exposure to different style premiums. So when you're looking to add an asset class to a portfolio, it makes perfect sense to start with the entire market of that asset class. So in our case today, for US equities, a perfect starting point would be owning an investment that tracks the Russell 3000 or some similar index like the Wilshire 5000. And the reason for that is pretty simple. The market has already efficiently allocated all available resources into pretty much the proper spot. So if we're going to stray away from this market portfolio, we have to have a pretty good reason for doing so. Over the last 30 or 40 years, academic research has found that there are many different drivers of return than just the total stock market as a whole. And there's been many of these drivers of return that have been discovered, but there are four of them that have kind of risen to the top to be true style premiums. The four of them are the equity premium, also known as beta, the size premium, the value premium, and the momentum premium. Now, on my blog in the past, I've profiled almost every one of these premiums, so I won't spend much time on what each one of these premiums are. But today we're going to talk about taking these different style premiums and incorporating them into a portfolio. So let's look at some return data. Throughout the presentation, we'll be looking at the time period January of 1980 through May of 2013. And over that time period, the Russell 3000 has had a compounded annualized return of 11.38%. It's had a standard deviation, a measure of volatility, of 15.72%. And risk return is basically just dividing its return divided by its standard deviation. So this gives us an idea of what type of risk return relationship it's had over the time period. And in the case of the Russell 3000, it's been 0.72. Now let's look at a couple other indexes that we will gain exposure to. The first one is the Dimensional US Large Cap Value Index, which, as the name implies, gains exposure to the value premium, and the AQR US Large Cap Momentum Index, which gains exposure to the momentum premium. Now, as you can see, gaining exposure to these different style premiums has definitely increased its return. So for the case of the value index here, we've increased to 13.19%. And in case of the momentum index, we've increased to 13.04%. But this increase in return does not come without an increase in risk, or in the way we're measuring risk today is volatility. So you can see that the value index has increased its volatility to 17%, and the momentum index has increased it all the way up to 18.35%. When we look at our risk-return relationship with these new indexes, the value index has done a little better than the market at 0.78%, and the momentum index is pretty similar, just a little bit worse at 0.71%. Now, the real value of diversifying across these style premiums comes when you combine these style premiums together. And the reason for that is because these different premiums are very uncorrelated, or in some cases negatively correlated with each other. If you've never seen a matrix like this before, basically, if you wanted to see what the correlation between, say, the market factor and the momentum factor is, you could see where these two intersect on the chart. And in this case, it was negative 0.12. Now, with correlations, a correlation of 1 means that, 1 goes up 2%, The other one goes up 2%. That would be a correlation of 1.0. So they're perfectly correlated. If one went up 2% and the other one went down 2%, that would be a correlation of negative 1.0. So as you can see that there are a lot of negative numbers here in red. So over this time period from January 1980 through May of 2013, for example, when the size factor was up, the value premium tended to be down. Now, over the entire period for which the academics have data for, the strongest negative correlation between the two has been momentum and value. In our shorter time period from 1980 till 2013, it looks like value and the market factor have had the most uncorrelated exposure to each other. But the first thing we're going to do in this example is combine value with momentum. So let's pretend we had a portfolio over our time period of 50% US large cap value index and 50% of the AQR US large cap momentum index. This new portfolio, which we rebalance annually, now it has an annual return of 13.4%, which is better than the Russell 3000, but its standard deviation only increases slightly from that to the Russell 3000 to 16.44. You also may have noticed that this new return of 13.4 is higher than each of the two indexes individually, and its standard deviation was lower than either one of those two indexes individually. And because of that, its risk-return relationship jumps up to 0.82%, which is much better than the Russell 3000's 0.72%. Now let's add the small premium to the mix. So to do this, we're going to get rid of that dimensional large cap value index, and we're going to own 50% of the dimensional targeted value index, which is a small value index. And we'll still own 50% of the US large cap momentum index. And when we do this, we can see that our return jumps up to 14.63% per year. Our standard deviation definitely does go up, but our risk-return relationship also went up to 0.84 as opposed to 0.72. Now, because our total risk measured as standard deviation in this case went up, if we wanted to bring that down to a more acceptable level, say to match that of the Russell 3000, we could do that by adding another uncorrelated asset to the mix. So to do this, we'll have a 45% allocation to our previous two indexes, our momentum index and our targeted value index, but we'll add a 10% allocation to 5-year Treasury notes. So when we do this, I call this portfolio US equity with bonds. You can see that our return has still stayed pretty high at 14.15%. Our standard deviation is now lower than that of the Russell 3000, and our risk-return relationship is much better than the Russell 3000 at 0.9. If we look at a chart of how $1 grew from 1980 through May of 2013, you can see that the blue line there of the US equity portfolio with the bonds did much better. $1 turned into about $82, where with the Russell 3000, $1 turned into $38 or so. And it did this with the same standard deviation or the same volatility, and another way to say that is that with the same risk of that of the Russell 3000. So as you can see, adding these uncorrelated style premiums together can really increase the efficiency of each asset class you own. And as you can probably imagine, if you did this with each asset class individually and combined that into one big portfolio, you could really have a very efficient portfolio, gaining the most amount of return for the least amount of risk. If you could please read our disclaimer to keep our lawyers happy, that would be great. We thank you for listening, and we will talk to you again soon.